Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino, financial planner with TC Wealth Management and Visa Wealth. For more information on me or to send in your questions, check out the show notes at treybino.ca/podcast. So let's get into the 12th episode. So this episode is on optimal asset allocation. What do you think that means? Hello, this is the editing Trey. Just a quick interruption. This episode does have a little bit of buzz to it due to a loose cable. Either way, I had a choice, either make my wife redo a 45-minute conversation or just post it and fix it for the next one. I value my life, so here is the episode. Who knew that audio would be so annoying? But we do have it figured out for future episodes, so it should be good. So don't feel bad if you have to skip this episode. That's okay. It should be good for future ones.
I think that means putting assets into the most efficient funds. Is that the right? Or vehicles, maybe? Like TFSA, RRSP, RDSP. Is that right?
No.
Okay.
So that's close. That's asset location. But allocation is really... we're going to keep it pretty simple. Is to focus on the difference between how much stocks you have in a portfolio and how much fixed income you have in a portfolio or bonds. So quick lesson. Bonds in a portfolio historically juice the long-term expected return because that's fixed income is that in general. So a bond is similar to a GIC.
Okay.
But instead of issued by a bank, it's issued by a company. So a company wants to borrow money. They need $100,000. It's normally a lot more than that, but let's say $100,000. They will say, depending on the risk of that company, they will say, okay, we'll offer the market 5% if people give me $100,000 and we'll pay it back in 10 years. And then that piece of paper or whatever is a bond. There was a period of time when people were pushed to buy like government bonds. So it was very popular that if you talk to like your grandparents' generation, they would have likely at some point bought government of Canada bonds. They might even have them sitting around.
Well, remember, I think I had a bond.
I think so, yeah.
We had to like go to the Ministry of Finance to cash it in. It was like $100. It was very small.
Yeah. So that's a bond. An equity or a stock is completely different. That's where you own part of a company. Whereas the stock market is what people typically think of. But it's really, it's equity versus or stocks versus fixed income.
Okay.
So when it comes to picking your investment allocation, that will determine your experience that you go through, like the experience, what you as an investor experience, your overall return. It will have a very large factor on that, a very large influence, should I say, on that. And picking something that you are comfortable with is really important to your experience.
And your outcome.
Your outcome. Huge to your outcome, but really important to your experience as well. Because, well, we'll look at it.
I might be jumping ahead, but I want to ask, is this like the pension plan thing where you're put into the balanced fund, but you're always like, put it into the equity fund? Is that asset allocation?
Yes, that's okay. So a balanced fund is typically 60-40. So 60% in equity and 40% in fixed income.
Yeah.
And then you have an income fund, which would be closer to the other way around, where you have about 30-40% in equity or stocks, and then the rest in fixed income.
Yeah.
And that is because of the way risk is measured. What you have is typically the higher the bond or the fixed income component, the lower the risk rating of that particular investment vehicle. So if it's a 60-40 balance fund, it's likely going to be low to medium risk rating.
Yeah.
If it's a 30-70 like income fund, then it's probably going to be rated as low. If it's a
That would be 70% of it is in bonds.
yeah,
30% is in equity.
Yeah.
And you would maybe choose that if you were like really close to retirement.
Well, I think you should never choose it, but yes,
Oh.
we would. Well, we'll get into reason why,
Yeah.
but yeah, yes, you would. Well, let's get into it.
Yeah.
So, first off, that's a really fundamental thing that you have to understand is that when you're thinking of risk, we've already talked a little bit about risk in a previous episode, but when you're thinking about risk, it is when you're talking about investment allocation between stocks and bonds, it does not mean that you are holding risky stocks in the stock part of that. So if it's
Right.
60-40, oftentimes, especially with pension funds and things, it will be the same equity. You just hold it in a smaller percentage of the portfolio,
Right.
which then controls the ups and downs of the portfolio. It
Yeah.
doesn't make the investments riskier from the point that people view risk, like the absolute risk. It will just, the higher the amount of equity, the higher the ups and downs that you will experience. We're not getting into what's in the equity and picking that option, like choosing.
So you're
between-
saying it's not like, okay, if you're choosing the equity fund, you're now invested 70% in weed stocks, Bitcoin. all
Yes,
those,
no, you're 100% correct. That is not
like the
way it
S&P
works.
500, either this much, this much, this much.
Yes,
Yeah.
basically. So if using the S&P 500, because you brought it up, if you had a just US balance fund, you could have 40% of it in government bonds and 60% in the S&P 500, and that would technically be 60-40 split, right? It's a balanced portfolio.
Yeah.
Or you could have 80% in the S&P 500 and 20% in government America bonds. Same thing, one's not suddenly more risky than the other, but that portfolio that is 80% is much more likely to experience larger ups and downs, larger swings.
It's the volatility thing.
Exactly.
Where it's like it's the definition of risk. If you want to learn more about risk, check out what is it, episode 5?
I don't even know what it was.
I don't know. One of our previous episodes, we talked about it. But yeah,
Yeah, episode 5. You got it right. Here you go.
look at that memory. Anyways, it's the volatility. So because there's 80%, because 80% of the funds that you have are in equity, that means the bigger number. How am I saying this? It makes so much sense in my head, and I'm like, now I'm trying to get it.
It's just you're
going to see more movement.
Yes.
Is essentially what it is versus the 60-40.
Correct. Yeah. So ultimately, a lot of advisors will say you should pick, you should start with, I do risk tolerance questionnaires with people as well. Mine's a little bit weird compared to what some other people use. But people think you should start with that, and then you kind of build up your risk tolerance. Me being the way I think people should do it the other way. And let's look at the paper that I wanted to look at.
Sure.
So there was a paper produced. It's called "Beyond the Status Quo: A Critical Assessment of Life Cycle Investment Advice," done by a few different universities: the University of Arizona, the University of Missouri at Columbia. A few different people got together.
Mm-hmm.
This is a pretty heavily researched topic for sure.
Okay.
But life cycle investment advice is what you was talking about. It's what the basic advice is when we're trying to, that advisors give out when you're trying to just determine somebody's risk or how they should be invested. So when you're younger, you have more stocks. When you're older, you increase the amount of bonds that you have. Okay. So this paper, I'll put it in the show notes and you can look at it. I'm not going to go through every single part of it. It's a little long, but basically they looked at how that fared throughout history.
Yep.
Okay. And they looked at risk through a completely different lens. So they looked at risk through the probability of financial ruin.
Okay.
So they took this couple, and depending on how they invested, they looked at probability of financial ruin and how much of their income they had to save in order to achieve their desired retirement. Okay, does that make sense?
Yep.
Okay, so I can't really show this to you. You're kind of sitting too far away. I don't know. Okay, so there's 4 charts here.
Okay.
Yeah.
We'll explain it because the listeners.
Yeah.
need to
Okay.
know.
So the first one is it compares if somebody was just invested in domestic stocks. So just if I was just investing in Canadian stocks.
Yep.
If I had a balanced approach throughout my entire life. If I used the as you get older, you increase your allocation towards bonds approach.
Yeah.
Or 100% equity. About 30% of it's in domestic stocks. Everything else is international. And it compared it in different scenarios. So if, for example, the inflation's a big one, people often talk about inflation. So we see the potential of financial ruin for the all equity approach, if inflation is really high, is around 18%. It's pretty high,
Yeah.
right? When it gets to a domestic stock portfolio, it's now at 40%.
Okay.
So 40% chance of financial ruin in this type of environment.
That's crazy.
When we get to, next up is balanced. The balanced portfolio is about 50%.
Oh,
50% chance of financial ruin.
That's crazy.
Yeah, I know. And then this is the most craziest one is, so the target date fund approach,
What's that one?
that's the one where you get more and more bonds the older that you get.
Oh, yeah.
So you dial back the risk.
Yeah.
The older you get, what do you think it was the chance of financial ruin?
Well, based on how you responded earlier when I was like, oh, and then in the pension, when you're older, you dial it back, you were like, no, not quite. So I'm guessing it's pretty bad.
Yeah, you have to give me a guess.
60%?
Yeah, about 65%. Just over 60%, 65% is the chance of financial ruin in a high inflation environment.
What does financial ruin mean? I mean, that just
Means you
sounds
can't
like
afford
so...
the retirement that they set out, which you can look into it for those wanting to listen. I'm not going to go into it, but the retirement that they'd laid out wasn't possible.
Okay.
So they ran out of money,
Okay.
right? So it's the chance of a bad outcome, right? That's what most people are scared of. They're not really, I mean, they might be scared of the markets going up and down in the moment, but most people know, okay, markets go up over time. Most people know that. The issue is that when markets go down, the fear is, oh no, now I can't retire. Now I can't go on that trip. Now I can't take my kids to Disneyland. Maybe like it's the stuff that they want to be able to do more than anything else. And that translates to people thinking, okay, now I'm low risk because I don't want the ups and downs of the portfolio.
Right.
Right. When most people, the real fear is I can't do what I wanted to do.
Yeah.
Right.
When things are, Sometimes I think of it too as, you talked about the trend going up. So even though that money is worth more, even in a down, it's almost like once you see the highest number, that number is the benchmark.
It's called anchoring bias. Yeah. Absolutely. Absolutely. And in this type of, if you were to choose a 100% equity portfolio for life, you would be susceptible to that, because even if you'd chosen that, and let's say your portfolio had grown and grown and grown over the last 10 years, and you now hit $1 million, and then it drops 30%, you're now thinking, I just lost $300,000, when in reality, if you had picked an income fund in that same amount of time, you wouldn't have even got to $1 million in the first place. You probably wouldn't even be at $700,000 right now. You'd be at $450,000, right? So, but people don't look at it like that.
Because they're like, no, I lost $300,000.
Exactly.
I don't know why I relate to that. I'm like, that makes sense to me. Which is bad, but I'm like...
We say people gain money in percentages and they lose money in dollars.
Oh,
That's
yeah,
what we say
that
in the
makes
industry.
sense.
It's like people think, okay, my portfolio is up 20%. That's a great year. But when it's down, they don't say, oh, my portfolio is down 5%. They say, my portfolio is down $65,000. And you're like, okay, but it's a $2 million portfolio. That's nothing. I do not lose any sleep over that. That's absolutely fine. But it's just a human nature. I'm not sure why people do that.
It's interesting, yeah. Because immediately I'm like, that is exactly how I would view it.
That's how you do it. That's what you've said to me.
Yeah. Give me back my money.
Yeah.
Stock market.
Yeah. So, but that's inflation. But what the whole paper basically goes through is that the way that the industry views risk, they don't agree with it. Like, these professors don't agree with it. And numbers prove that for the best outcome is 100% equity throughout your life. Now, does that mean that everybody should be 100% equity? I would argue yes.
Mathematically.
Mathematically.
Remember, it's like there's so many common themes in this podcast already. I'm like tying it all together because, yeah, again, this is the problem with like the optimization thing. And like, yes, money is numbers, money is math, money is logic, except that we're all humans and we all have feelings. So it's like not quite like, yeah. Anyways, sorry, I kind of stole that from you, but I'm sure that's kind of where you were going.
Yeah, that's pretty much it. It's great seeing it on paper.
Yeah.
It's harder to implement into it in practice. I was actually having this conversation with a client today where we were looking at the potential of leveraging. So they'd paid off their mortgage, and we're looking at taking a sizable amount out of the mortgage in order to invest it. It was about $200,000, which is a lot of money.
Yeah.
$200,000 out. They're relatively close to their retirement, and we were discussing the pros and cons of it, not going into specifics, but on paper, leveraging makes a ton of sense.
Yeah.
It really does. In practice, it's very different. So like we went over the last 5 years or so even, and the last 5 years have been incredible in the markets. But even then, there were 2-3 year periods where, I mean, if you started in 2020, it looked great, but that if it was $100,000, I think it went to 160 and then back down to 140, or it went up to 130 and then down to 100. I can't remember what it was exactly.
The exact numbers.
But it's not all rainbows and sunshine and rainbows. Yes, over the long term, yeah, you made a ton of money. Still, you have to get through it. So while the paper does show 100% equity portfolio is the optimal way to do things, doesn't mean it's right for everybody. But what I would say is people should, when you're starting out investing, I truly, truly think it is a disservice for you to start off in like low risk investments. Mm-hmm. And I say low risk, I'm going to be a little bit more specific. I think it's a mistake not to start with a 100% equity portfolio. I think people should start with a 100% equity portfolio.
And then if they can't handle it, dial it back.
Yeah. Right. And try to, and if they can't handle it, they should make sure they understand it and then dial it back because starting out with $10,000 and the market's dropped 20% and you realize you can't handle it at all, but you've seen that $10,000 go to 15 and then you've seen it drop to 20%. Like, I think that's a much easier journey to go through than starting really slow
numbers
and then getting to $200,000, $300,000, $400,000, $500,000 and then going through that emotional roller coaster. Mm-hmm. It's just, for most people, I think the best decision would be to start at 100% equity. And a 100% equity portfolio is typically like a fully diversified global portfolio. You're looking at medium risk, like a medium risk rating on you're not talking about high risk. I'm not talking about high risk investments.
Yeah.
Large companies. I'm a big believer in index style investing. So low cost, globally diversified equity portfolio, I think it's a great way for people to start off the process of investing and learn. Because ultimately, if you lose 10% in the markets and realize I can't do this, and either you should be learning more or it's not for you, well, you will learn that better, I guess. It's much better to do it that way than to
panic sell or something.
Yeah.
Like you don't want to risk actually. It's like the actual risk is you. As the person, like the human element, you're the risk.
Absolutely.
That's how
Humans
we
are.
should measure risk somehow that way. Okay,
Absolutely.
this is reminding me though. Do you remember for my, I was working at another credit union and on their marketing team, and I had to find a game I was kind of helping with their financial literacy program. And I found a game online. Do you remember? It was this asset
Yes.
allocation.
Where you got to pick, it went back the last however many years, and you got to pick, you got given a certain amount of money every single
Yeah.
like paycheck, and you kind of lived through a life and you had to decide where it went.
It was like, yes, because, and I remember it had equity, bonds,
Gold.
There was like
had
corn.
like
It's like
commodities. It had a
resources.
bunch of stuff.
Yep.
And I beat your score
Yes,
by a landslide. And what did I do?
you did 100% equity. I was buying corn. I was like, what's this? I was like, I should put a little bit in everything. I'm just gonna
I didn't touch anything else. I went from, I think I had a little bit of cash, because I was thinking to myself, because they would like give you like life. We should see if we can find it. If I can find this game, I'm gonna try to
Yes.
find it and we can put it in the show notes.
Sure.
But it would
Yeah.
give you like different things happen in your life, and you have to decide what to do with it. Now I'm sad that I kind of, I mean, but it's technically possible to beat, right? Like you could go and beat it if you pick the right things and time the market, etc. Like you can buy and sell whenever you wanted. But all I did was, because I know the numbers, I did what I do in real life, and I put it all into global equity, 100%, kept a little bit of cash.
By the way, it's very annoying to find a game like this, and I played it, of course, because I wanted to see what it would be like if we were going to use it for students. And I sent it to my other teammates, like a few of them, and I was like, oh, try this game. I think one guy did it. And then later I was like, oh, you should try. Like, this is what I got. What was I thinking? What was I thinking? Of course he's going to win against me. Like, ugh, so annoying. Never play a financial game with a financial plan.
Yeah, that and Monopoly. People don't like playing
Oh,
Monopoly with me either.
No.
So
You know that I don't do that anymore.
Yeah. no,
I'm
it's
out for
fair.
Monopoly.
It's fair. We're getting off topic. Okay.
Yeah.
So we know what the numbers say. The numbers say 100% equity.
Yeah.
Sorry, I'm going to go back. Sorry, one more comment I really want to make is that people get used to whatever you get used to. And I think that people that, like, why aren't people used to the money that they have fluctuating every day?
Because they're used to a checking and savings account. It just stagnates.
Right? If that has never been the standard, people would become more comfortable with the markets. The markets go up and down. So what? That's how the markets work. It's because people either are liking it to their past experience, a savings account. Well, it's not the savings account, but it doesn't mean that it's now suddenly too risky, right? Like it's just people get this idea that this is the way that, like, it's almost like a negative thing that it's going up and down. When in reality, that's just the way it works. That's the price of making money while you sleep. It's worked that way for a long, long time. There's lots of ups. There's lots of downs.
I think it is. Honestly, I do think the anchoring bias is the biggest thing. Because you say, yeah, the markets go up and down. People don't care when the market's going up.
No, it was
Volatility one way is great. People
Yes.
are like, we'll take the ups. But they
Yes.
don't. They're like, oh, I lost my money. It's not your money yet.
And for some reason, and the industry does it as well, all of us do it, where we tie returns to years. Like, why do I care what 2025 does, or 2023 does, or 2001 does? Why would I not just look at what I make from now until I need the money? Mm-hmm. I never. That's always.
It's like we need to track somehow. People are like, I got to see if it's still going in the right direction.
And then they'll make decisions based on what it's done in the past year or last 6 months or last 2 years even, when it's like, okay, but what's the alternative? Like truly, what's the alternative for most people? I would say the markets, when it comes to like ranking of what to do with money, I would say they're pretty low on my list, like my order of what to do with your money, right? But there's no other alternative for me, right? I think of it as like the first thing I'd want to do with money, like the best way to make a return is to self-educate, right? To improve your own earning capability. Probably the best thing to do with money that you want to invest, right? And then you're looking at businesses, like small businesses. The vast majority of millionaires and people worth tens of millions of dollars, they did it through businesses, right? They started their own business and learned how to do that properly and have nailed their industry and do it very well. Only once you've exhausted those or can't do those things, you know what? I would even say real estate is another great place to put money if you're going to do it yourself. Great place because you can leverage it. But after that, what other option do you have? You have the markets, or you leave it in cash. Well, we've already discussed that. That to me is crazy. We left like the US left the gold standard a long time ago. That's a terrible idea. It's been a terrible idea. For some reason, people still like to do it. We know it's a terrible idea. Everybody knows it's just people still like to do it. You need to leave some for sure. You need to live, but everybody knows it's a bad idea to leave it in cash. But at that point, what other alternative do you have? To me, the only alternative is follow the data and you invest in the markets. And ideally, you have the financial literacy to have a high risk tolerance. And there's a direct correlation between somebody's risk tolerance and their financial literacy.
Yeah.
The more somebody knows, the more willing they are to take on market fluctuations, market risk.
Yeah, that makes complete sense. Because same, again, like when I started working in the financial industry, I knew nothing. Very, very low financial literacy. And I remember like the advisors teaching me just the basic stuff about investing. And I was like, oh, I would have definitely been like a GIC only person.
Yeah.
I was so young. I think I started when I was 18, but still, like, young people need to understand this too, right? Like, those are your prime years to be investing. So if you're sitting with a ton of cash or in GICs, you're wasting your potential, basically, your earning potential. I don't know.
Yeah, you are. It's wasting time. And it's interesting because I would say that during those years are really formative to how you're going to invest for your entire life. And if you learn young and you don't force extra decisions, like a really big extra decision people often find themselves in is, when do I invest this lump sum of cash that I have been accumulating for the past 3 years?
Right now.
Yeah. And it's like, well, the truth is 3 years ago, right? Like it's, if you put yourself in a position where you don't have tons of cash sitting around doing nothing and you're constantly putting money into the markets so that you don't have these giant decisions, then timing the markets isn't an option. You're likely to do better doing it that way than other ways. And honestly, once you've been invested for a certain amount of time, even if the markets drop 20, 30, 50%, you're still up. Like you're still ahead because you've been investing for so long. And granted, there will be a crash. I know that there's very little that I can guarantee. Like almost nothing. Like especially as an with all the compliance, very little I can guarantee. I feel pretty confident in saying that I don't guarantee, but I probably would be willing to.
I'm like, are you even on
Would be, probably not, but would be that we're going to have another market crash at some point in the future.
Yeah.
Right? It's like, we know it's going to happen at some point. There's going to be something. So you deal with it. I don't know. Like anyway.
You go through it.
You go through it. You make a plan for what you're going to do when that happens, and you make sure you can execute when it does happen. And something that I often teach would be, it's a a mindset to invest to the right time frame. So if somebody isn't comfortable being 100% equity like we are, and like I'm okay putting money in today that I need next year, or I might need next year. If I don't need it, if the market's down and I needed it, I would just take it from a line of credit or something. Like I'm perfectly comfortable doing that. If you're not comfortable with approaching life that way and being flexible, investing to the right time frame is the way to go. So what that would look like would be any money you need within 3 years, you would be keeping in very accessible cash and cash equivalents. Anything you need 3 to 5, 7 years, it would be fixed income like bonds and GICs, that's fixed income. And then you could, on the longer end of that, start to incorporate some high quality equity. And then above that, like 10 plus years, you should be pretty close to a high amount of equity, a very high amount of equity. 15 plus years, I would struggle to find good enough reason not to be 100% equity for that type of time frame.
Right. So basically what you're saying is like a pension fund when you're starting a job at 18 years old.
100% equity.
100% equity because you can't even take it out. You can't, even if you want to.
Even if you wanted to, you can't do anything with it,
so
right?
You might as well make money.
And Warren Buffett made a comment about, he said, I would rather guess at what companies are still going to be around in 20 years than what interest rates are going to be in 20 years. And with bonds, people think they're less risky and they rate as less risky on the fund, but there's still risks associated with them. There's different types of risks to equity, but I would argue that with a bond, with fixed income, the risk of a bad outcome increases over time, but with the risk of a bad outcome when it comes to equity decreases over time.
Right.
So bonds are riskier long term and stocks are less risky long term.
That makes sense.
Stocks are riskier short term and bonds are less risky of a bad outcome short term. Yeah. So as long as you pick the appropriate investment to the time frame, you're almost picking the lowest risk of a bad outcome.
Yeah, for your goal.
Investment for the goal, for the time frame that you could be investing it. For the time frame until you spend the money. Spending the money is really important. Like when you spend the money, because people do this in retirement a lot where they think, okay, I'm retiring at 60. That means by 60, I need to be, if they are following the traditional target date type of philosophy, then they're like, by 60, I need to be 70% in fixed income and 30. It's like, no, at 60 years old, the average Canadian makes it till early 80s. You still have a long way of investing to go. You should be investing it according to when you're going to spend the money.
Right.
So that's how you almost would, you could very well could assign each dollar a time frame, and that's how you build a portfolio. And it would be, if somebody wants to stick to that type of approach, they would have a pretty good investment experience. They would get through the majority of any scary things that we've had, as long as the numbers work and things like that. But that's a good way to determine, you're not comfortable with doing like 100% equity. That's a good way to determine how you should be invested and your investment allocation. So instead of thinking it as, 40% stocks or 60% stocks or 80% stocks, you build it according exactly to your goals and when you're going to spend the money. And then you have your allocation and you can kind of work backwards from there to determine your expected rate of return, etc. And that's one really good way to do it. The other way that you would determine your investment allocation, we've touched on this briefly, is your risk tolerance. Again, I would be really cautious on saying that this should be the driver, because most people do not understand enough to make an informed decision. There's an argument often in the healthcare sector about informed consent.
Yeah.
And that is something that at a certain point when it comes to a doctor and a patient, it's very difficult to get there. Yeah. Most people don't understand enough to make a truly informed decision.
Yeah.
So you end up relying heavily on what the doctor says. And this is the similar type of world where for you advisors, most of your clients don't know enough to make an informed decision.
Yeah.
So that's your job, is to determine where they should be and try to coach them to that level based on capacity. So capacity is a really important one when determining where your investment your investment allocation. Capacity is objectively what type of risk can you take. So, for example, I would say people should start off with a 100% equity portfolio, but that wouldn't be true if it was the first time they're investing, they haven't invested ever before, and they're investing a large lump sum that if the markets are down tomorrow, they can't put food on their table.
That's crazy.
Very different investment allocation, right? Because they don't have the capacity to take the risk.
Right.
Versus a young professional that's just starting his accounting career, and he's earning $80,000 a year, just got an apartment, has free cash flow, is saving $1,000 a month. If worst case scenario happens to him, well, he doesn't go on the vacation, or he takes it from a line of credit and moves on, right? Very different risk capacity. So your capacity to take risk and have those short-term fluctuations is really important. But I would also caution that you should be investing once you have a fully funded emergency fund, and you have the basics covered already.
Yeah.
So if you are investing your emergency fund, that's not the point. You need to be, it needs to be in its place, and you can't just that could be, I would consider that almost too risky. If you can't live with the consequences of the market being down 30%, you need to reallocate, right? That's why I gave those type of time frames, because they're significantly safer. It's a good way to go about and think about investing. You could end up with a pretty good idea and a pretty good asset allocation. And then the other one would be tax considerations, and we'll get to this more when we talk about tax location, which is what you was talking about earlier.
Oh, okay.
But you should look at your asset allocation among all of your accounts. So different types of investments are better suited tax-wise to certain types of accounts.
Right.
A brief example is inside of an investment account in a corporation. So let's say I run a business and it's incorporated, and I have an investment account within the corporation. I also have TFSAs, RRSPs. Let's keep it simple and keep the three. Then there's certain types of investments that make more sense after tax. You get more money after tax in certain places. So inside of a corporation, foreign dividends are taxed very heavily in Canada. So maybe I'd have my foreign dividends inside of my RRSPs, right? Where there's very little penalty for it. Or inside of the corporation, equity is better. So capital gains, which is what happens when you sell a stock for more than you paid for it.
Okay.
That gap is called a capital gain. Capital gains are very attractive inside of a corporation. You can do some really cool planning things with it to reduce tax, etc. So maybe I would put myself in a situation where maybe I'm a 60-40 investor, but I keep my 40% of bonds out of the corporation, because after tax, it makes more sense. So that corporate account might be 100% equity, but overall, it's not.
Yeah.
Okay. So that's one way that you could allocate and figure out your asset allocation.
I'm definitely seeing why you like your job so much more and more, because this all sounds very almost like a puzzle. Like every single client and situation you deal with is different, and you have to figure out how to make it work with all these factors coming in. It's like, can they handle it? What's their capacity? What are they like as a person? Are their emotions going to get out of hand? Okay, how much money do they have? What's the tax implications? There's
a lot. There's a lot that goes into making recommendations like that, because you're right. That's part of the reason I enjoy it.
Yeah.
I do think
This is
think
really
so.
complicated and like a giant puzzle. That's why Trey likes it.
Yeah, and there's no perfect solution for everybody. Everybody's different. Everybody's unique, and because of the nature of it, you have to know a lot about a wide variety of different topics, from tax to law to the investing piece to foreign tax policy. Like there's I don't know. I find it really interesting. It's
Yeah.
the nerdy part of me. I don't know. But yeah, this is a really important one, that if you are going to spend any time focus, and you can only focus on one area, apart from budgeting, I would say that's probably the most important. But foundationally, this would be it. And this is not. I'll be very clear. We'll do another topic on like people thinking that they should know more than they do. But this is an area where it doesn't matter how successful you are in your career. A lot of people get it wrong. And when you don't understand it, it's very easy to get wrong. I've worked with people that are worth tens of millions of dollars that don't have this right.
Yeah.
And a lot of it is just either it scares them, which is very fair. Farmers is a huge one where this can get very scary very quickly, because for a lot of farmers, they run very lean operations cash-wise until they sell it.
Yes.
And they go from, having basically everything going back into the farm to suddenly having a $10 million check. And now they're learning, and they've never invested before. Like I talked about at the beginning, like asset allocation is so important, but that can also terrify them. And then they'll make mistakes with it, and you can't get time back. So somebody that is willing to learn and to understand that, a $10 million portfolio that goes up and down 10% every 2 years as normal in the markets, that's $1 million fluctuating.
Yeah, that's crazy.
That is huge. That is crazy.
But then I'm like, if you have $10 million, like...
Well, that's part of it.
That's pretty good.
Then people will say, like, the biggest argument for not allocating appropriately would be, well, I can just live off this, right? And that is true, unless you go back to Germany, where the currency gets devalued, and you have the inflationary concerns, or you go back to any of the other hundreds of currencies that have disappeared and changed. We are not on the gold standard. Our currency is not backed by gold. So you cannot just say, oh, I'll just like put it in the bank and live off the interest, because things can go really wrong. It can go really, really wrong. Yeah. And it's a case of, yes, that you might choose to do that with some of it. But when it comes to risk and financial risk and types of risk, you want to be in a position where everything hurts a little bit and nothing hurts
a lot.
And nothing will kill you. Yes. Yeah. Because
financial ruin.
Yes, exactly. You don't want to, yes, $10 million might seem a lot, but $10 million back in Germany when the currency was worthless suddenly buys you a loaf of bread. I wish when people made these type of decisions, they look at the what's happened throughout history and what's happened to different economies and currencies and investments, and make an informed decision. Because the least risky thing for this individual to do that has this $10 million pot of financial ruin is to take $2 million of it, put it in GACs, and take the rest, the 8, and stick it into a globally diversified index fund. Yes, the index fund will go up and down. It'll go up and down a lot. Over time, though, you'll be able to buy stuff with it.
I love how
there's other stuff. Obviously, I'm being very, very general. This is not advice specific or anything like that. I'm just saying, just look at the big picture.
Yeah. I just wanted to call you out because you're like, I wish people would just make an informed decision. As earlier you were like, it's really hard for people to make a truly informed decision. It's like, the problem with all that stuff you just talked about? Here's my little rant on the side. The problem with that is by the time, by the time someone can make an informed decision, if they even get that far, because that's a lot of work for people who are maybe not interested in this, they're doing other things, it's not their profession, blah, blah, blah. They've lost all that time.
And they beat themselves up for it afterwards.
Well, it's like, was it the best decision because they've lost all that time? Yes, but
yeah.
I'm thinking about the health industry more so because it's like, if a doctor, I'm going to use a drug, for example. If a doctor says to you, hey, you have this condition and you have to pick one of these 8 drugs if you'd like to treat your condition, which drug do you want? And you're like, I don't know, which drug should I take? And they're like, we can't tell you. You have to do the work yourself. You're like, oh my goodness, I'm completely overwhelmed. And that's only, they're like, oh, it's just 8 drugs for this. You know what I mean? It's like but I have to, or whoever has to make the decision and at the best that they can based on the information they have, because they have to start treatment. You know what I mean?
This topic is way easier than...
Of course you think that.
That would scare me. I'm like, oh, that'd be a terrible decision to make. This is easy. It's clear. There's clear choices. Yeah.
That was just my little side rant. Because you were like, oh, I just wish, of course, everybody wishes they were just a genius in everything. Then life would be very easy to make decisions.
Yes, and you're not going to know everything. You're right, but there are some fundamental principles that I think everybody could learn very quickly.
We always have to. What is with us in the podcast?
Because it's 12:30. We go to bed.
We need to go to bed.
Okay.
Life as parents doing this is hard.
I don't think we've done a single one of these episodes, and it's not been past midnight at this point. Anyway, I think we'll leave it there.
Good idea.
Yes. The next one is, what I wanted to do was do a few episodes on what we do for stuff. So I have managing day-to-day finances, talking about investment products and things like that, retirement planning, etc. So the next few will be, instead of talking, because as you mentioned, there's so many different variables and things like that, I wanted to talk through what we do, the reason we do it, and then in future episodes we can get to some of the other variables that might change people's route, right?
Yep.
So that's what we'll do in the next episode. Okay.
Awesome.
See you later.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.